Today's highlights: BTC fees are all negative, liquidity is stuck, ETH deposits are surging, B's profit-turning strategy is under heavy attack from bears, where is the path for the fasting mode, and how far-reaching is El Salvador's move to open Bitcoin classes? Thursday, February 26th, Chinese Channel B link, where is it? I'm Dong Dong. Let's first look at the past 24 hours in the crypto world. The most important data headline: after this wave of sell-offs, the overall market sentiment has changed. Funding rates across all exchanges have collectively turned negative, which indicates that the bears are starting to take the upper hand. When the price was being pushed down toward the $60,000 mark, the funding rate was driven even lower, at one point hitting around negative 0.02, a classic signal of bears piling on their positions. However, the rate then gradually recovered, returning to around negative 0.01. Although it's still negative, it's more of a calm mode and nowhere near the kind of extreme tension we've seen historically. Simply put, bearish sentiment is heating up, but the market hasn't reached a state of panic yet. What happens next depends on how the key levels play out. If the price can hold steady, short covering could quickly turn into upward momentum. But if the support level is broken, the funding rate often widens again, accelerating the current trend. Right now, it looks more like a tug of war, with the price stuck around $65,000, the funding rate below neutral, and short positions quietly accumulating. Whichever side, bulls or bears, breaks the balance first, the direction will tilt that way. To put it plainly, the current situation with Bitcoin is not just about the price fluctuating a bit. It's more like the flow of money has stalled, with several cyclical oscillation indicators like SSR all suppressed in the negative zone. The meaning is actually quite straightforward. There's no shortage of stablecoins in the market, but this money hasn't been flowing back into spot positions in a big way. When prices hit $120,000 at year-end, it was still an expansion. Then, the pace shifted toward contraction with lower highs. Typically, a downward SSR means abundant stablecoins, suggesting ready ammunition and positive oscillators. However, negative oscillators show risk appetite hasn't opened. Most remain sidelined. Historically, this structure appears near key market turning points. But the premise is that the price must first stabilize, and the indicators need to start recovering. Before stablecoins begin to flow back into the spot market on a large scale, overall liquidity remains relatively passive. In other words, what really matters for Bitcoin going forward may not necessarily be the price itself. Instead, it's about capital confidence and stability. Can the demand for coins recover? Recently, there's been an interesting detail. Binance's ETH deposit addresses suddenly became very active, jumping from around 360,000 to over 450,000, and this almost happened in sync with the price dropping from $49,000 to $1,900. In the market, there are generally two common interpretations of this. Either someone couldn't withstand the volatility and sent their coins to the exchange, preparing to cash out, or the price broke a key level and some funds were forced to come in to add margin. In either case, when deposits increase, the amount of coins that can be traded at any time naturally goes up. Short-term volatility also tends to be more intense. But experienced players all know that historically, these kinds of deposit surges, when they pile up and get amplified, often appear near the end of a market trend or during phases of concentrated emotional release. The key is to see whether the subsequent selling pressure is quickly absorbed or continues to build up. If the sell orders are eaten up, then this wave looks more like a capitulation-style release. But if the buying strength is insufficient, this will inevitably prolong the consolidation period. Please like and turn on notifications for continuous news updates 24/7. Our channel provides 15-minute macro insights to help you quickly grasp major changes in the digital asset sector and enhance your understanding. Let's look at the news. In this round of the market, one of the most promising main players is not an exchange nor a public blockchain, but rather a company that everyone on our channel is very familiar with: Strategy. A few years ago, this company was in the software business, but now it has become an enterprise-level Bitcoin holder. Its stock price is tightly linked to Bitcoin. When the market is hot, it acts like an amplifier. When the market pulls back, the pressure is amplified as well. With a large amount of Bitcoin held on its books and the cost clearly visible, any price fluctuation immediately causes market sentiment to swing. So, the storyline is also quite typical. Bulls treat it as a symbol of faith, while bears see it as a target for volatility. The controversy and trading volume both heat up together.
Data shows that among U.S. companies with a market capitalization of over $25 billion, Strategy has become one of the stocks with the highest short interest. About 14% of its market value has been borrowed for short selling. The company's founder, Michael Saylor, admits that the market has entered a correction phase, but he still maintains a relatively optimistic outlook, believing that this cycle may be milder than previous ones.
What I'm saying is that the wealth of the entire world is increasing, not only because of innovation and technology, but also due to inflation. People are considering selling their Central African real estate to buy Bitcoin, or selling their Siberian natural gas to buy Bitcoin, or selling their Argentine currency to buy Bitcoin. As people move their capital into this global monetary asset, that asset class is going to grow even faster.
Data shows the U.S. stock market's short-selling ratio is at its highest in almost a decade. Risk appetite is more cautious, and short sellers have shifted from AI stocks to Bitcoin-related stocks. In addition to Strategy, Coinbase is also among the most heavily shorted stocks. Market observers believe that the concentration of short-selling activity reflects institutions' ongoing concerns about volatility and valuation risks.
The current situation with Strategy, to put it plainly, is that the market is starting to reassess the approach of using high leverage to bet on Bitcoin. When the market is favorable, it acts as a profit amplifier, but when volatility hits, the risks are amplified as well. The real focus of debate isn't about the amount of unrealized losses, but rather whether this model can survive through the cycle. On the other hand, within the industry, there's also a quiet shift happening, restructuring towards DeFi income and institutional funds. On-chain asset tokenization is also moving forward. Bear markets are often the most lively, but real changes usually happen beneath the surface. Compared to emotional swings, the market cares more about who has cash flow, who has support, and who can survive the longest. Right now, the Bitcoin market is anything but easy. Prices are volatile, regulations are tightening, and the overall market sentiment is cooling down as a result. At this moment, our channel's old acquaintance, El Salvador, is once again thrust into the spotlight. Ever since it was the first to elevate Bitcoin to legal tender status, this path has always been accompanied by both applause and skepticism. When the market is doing well, everyone talks about ideals, but as soon as the market cools down, the debates immediately return home for a reset. What's even more interesting is that, even while negotiating a financing framework with the International Monetary Fund, El Salvador hasn't hit the brakes. Instead, it's continuing to push forward. Through ups and downs, they keep moving forward. This attitude has sparked further public debate. Following intense discussion, the country has made a new move, refocusing public attention.
Recently, El Salvador's National Bitcoin Office announced the launch of the Bitcoin Diploma 2.0 program, marking a further institutionalization of Bitcoin and financial literacy education. According to the policy, public schools are required to schedule 3 hours of classes per week starting from the elementary level, and to deploy AI tutor systems in approximately 5,000 schools, thereby creating an educational framework that combines Bitcoin and AI. The government emphasizes this project promotes tech and financial awareness and aligns with national currency strategy. Meanwhile, official data shows the government's Bitcoin holdings have surpassed 7,500 coins.
If we look at the longer timeline, the real point of interest in El Salvador's move may not lie in the price of Bitcoin itself. Right now, market sentiment is rather cautious. Institutions are talking about compliance and risk control. People are no longer so easily swayed by stories, and many participants have chosen to pull back. But El Salvador's approach is clearly different. While others are still debating price fluctuations, they have already incorporated Bitcoin into the classroom, shifting the question to the next generation. How should we understand currency? Short-term pressures exist, volatility and competition. But this is a marathon, not a sprint. He bets on cycles of perception and institutions. He chooses to keep moving forward. While others eye fluctuations, he looks long-term. While others calculate balance sheets, he thinks further ahead. It's about blocking out the structure. In a bear market, what's being tested isn't just the price, but also the path and patience. As the market cools and chaos abounds, how should crypto investors hedge against risks? The trillion-dollar payments sector is being rewritten by AI, so how can we break through the bottlenecks in cross-border payments? In recent years, the crypto world has been busy upgrading compliance and attracting capital. But on the other hand, risks have also evolved. The data speaks plainly. Losses from scams easily reach tens of billions of dollars, and AI-powered impersonation and social engineering are becoming ever more sophisticated, with astonishing growth rates. In a boom, enthusiasm masks hidden dangers, but when it cools, trust and operational risks surface at once. Ultimately, market cycles test prices, human nature, and our defenses. Risks are sown when we are relaxed, erupting collectively when tension peaks.
Recently, law enforcement agencies in multiple countries have continued to disclose cases of scams and fund-related incidents involving crypto assets. Federal law enforcement officers in the United States seized more than $61 million worth of USDT in North Carolina. Investigations revealed that the funds were linked to a typical pig butchering-style crypto investment scam. The operation involved in the case included fabricating identities to build trust, forging trading platforms and profit curves, and during the withdrawal stage, carrying out additional exploitation under the pretense of fees and margin requirements.
First of all, the reason they call it pig butchering is because the scammers start by building trust with their victims, luring them in and fattening them up for the slaughter, just like pig farmers do before they slaughter their pigs. Well, in this case, the scammers slaughter the victims by stealing thousands, even hundreds of thousands of dollars from them. Now, this is a $15 billion cryptocurrency fraud scheme.
Beyond fraud, crypto investment disputes and losses frequently attract significant attention. In South Korea, a case has already entered judicial proceedings where the suspect faces attempted murder charges for poisoning a business partner following losses from crypto investments. The case is expected to be heard in March at the Seoul Eastern District Court. This incident highlights how, in a market environment characterized by high volatility and high risk, financial pressures and trust issues can further amplify behavioral and legal risks.
When the market heats up, emotions run high. Risk is often the first thing people automatically overlook. As soon as prices pull back and confidence cools down, all sorts of problems start lining up to make an appearance. Whether it's fraud, disputes, or even those seemingly extreme incidents, at the end of the day, they all grow from the same soil. High volatility, lofty expectations, and emotions running at full throttle. No matter how advanced the technology gets, it can never replace sound judgment. The stories of making money may change every day, but the old script of risk never goes offline. The real moments that set people apart usually don't happen when the market is at its most frenzied. Instead, it's the moment when cycles and human nature come together to yield a full harvest. Back then, it wasn't about who had the most guts, but about who could hold their boundaries and maintain a steady pace. Now, this wave of AI is just too overwhelming. It's not just engineers talking about models anymore, even the stock market and business owners are losing sleep over it. Recently, the market dropped by $800 billion in one go, and the atmosphere felt like the end of the world. Everyone's got AI taking our jobs on their minds. Models like Cloud can write code, check security, and boost efficiency. When it unleashes its full combo, it really does make you feel. White-collar workers are getting anxious, but every time the market encounters a new technology, it always loves to scare itself first. Only after things calm down do people realize that the real drama was never about the panic itself, but about how the industry reshuffles, where the money will flow, and who will be the last one standing under the new rules.
The impact of artificial intelligence on job structures is accelerating and becoming more apparent. Multiple corporate and industry surveys have shown this. With automation replacing jobs and functional restructuring continuing to advance, Stripe has sent a clear signal in its annual report under this backdrop. Commercial and payment infrastructure is entering a phase of reconstruction. Last year, Stripe's network transaction volume reached $1.9 trillion, accounting for about 1.6% of global GDP. However, the company emphasizes that the core variable has shifted to AI-driven changes in business models, rather than simply focusing on scale growth.
And I'd imagine back in 2019 and 2020, and I talked to CEOs who are replacing thousands of customer service workers with AI, entire design departments, even coders are being supplanted. Becky and I were just talking about how we used to tell our kids, hey, if you major in computer science, you'll be set. And now those graduates are having a hard time finding jobs.
Companies are streamlining product cycles as globalization accelerates. However, cross-border capital systems are lagging, with friction during clearing and compliance creating a structural bottleneck. Accelerating the deployment of stablecoins and business-to-business payments while simultaneously testing proprietary chains, advancing proxy payment protocols, and exploring machine wallet models for artificial intelligence agents. The business focus is shifting from payment services to the financial operations layer.
The recent market has been swinging back and forth, and companies have been making frequent moves. Ultimately, it's AI behind the scenes rewriting the script with new technology. On one hand, it squeezes jobs and redistributes the pie, making people uneasy. On the other hand, it drives costs down and speeds up entrepreneurship, making doing business faster and more efficient. Right now, the real battleground isn't product features, but who controls the faucet of transactions and settlements. Although the market always focuses on the pain and anxiety, in the long run, the real trend is increased productivity and reduced friction. Rules and pathways are quietly being upgraded.
Hey Yi reposted a video on X of Jamie Dimon talking about blockchain and tokenization and left a thought-provoking comment. The future will arrive with a storm. The bigger the waves, the more valuable the fish. As soon as the market saw this, the mood immediately picked up. Earlier today, NVIDIA released its fiscal year 2026 Quarter 4 financial report, and Wall Street had already set the stage for high growth. Revenue is aiming high, $66 billion. The real focus isn't just the number, but how management sets the tone. Will the AI investment frenzy keep surging, or is it starting to cool down? California's regulatory hammer is about to drop. The DeFi licensing regime will officially launch in July. Many crypto companies will either have to get certified to operate or rethink their territory. The issue isn't just compliance, but a recalculation of cost efficiency and survival space. Hogan has once again welcomed a traditional finance player. Brazil's leading foreign exchange bank has brought its fiat-backed stablecoin, BBRL, onto Polygon. Simply put, local fiat currencies are now looking to the blockchain for greater efficiency. This time, Bank of America has made a rather bold statement. They predict that in the next 12 months, it's not impossible for gold prices to surge to $6,000 per ounce. In other words, with multiple variables like interest rate trajectories, hedging demand, and asset reallocation all coming into play, the market is still hesitant to draw any firm conclusions about the ceiling for average prices.
The biggest illusion in the market these past years has been mistaking information advantage for profit advantage. Nowadays, on-chain data is publicly available in real time, news spreads in seconds, and social platforms bombard us around the clock. Transparency is at an all-time high, but making money hasn't actually become any easier. For most people, by the time retail investors see trending topics, breaking good or bad news, and so on, it has usually already been priced in. You think you're chasing opportunities, but in reality, you're just following the volatility. By 2026, the core of competition has already shifted. It's no longer about who knows more, but about who understands more deeply, who reacts faster, and who executes more steadily. What truly creates a gap isn't the news itself, but the framework for interpretation and the discipline system. Information determines the market trend, but structure determines profit and loss. In an environment where high volatility and high noise coexist, being a step behind is a risk, and being emotional is a cost. The market never rewards those who hear the story first, but favors those who can maintain stable decision-making amid uncertainty. Alright, that's the in-depth analysis for this episode. Our channel will always focus on the core of the digital asset field. It is about value discovery. If you agree with our logic, feel free to stay updated with the latest news and enable real-time notifications. If you want access to higher-level research reports, you can follow our advanced channel. From Monday to Friday, we share our personal in-depth reviews of market cycles, capturing certain opportunities within trends. See you again tomorrow.